This video is going to show you the importance of understanding your gross profit, and in particular the gross profit percentage in reading a profit and loss statement. Now, a profit and loss statement can also be called an income statement, and it can be called a number of different things, but basically it means the same thing. So the first part of a profit and loss statement, we have these key areas. At the top we have the sales and income. Sales, obviously, if you're a reseller of goods, then it's the amount of sales that you've made of those particular goods. And with income, it may be that you're a tradesman, a consultancy service, or something along those lines where you're receiving an income but not actually selling anything other than a service. So that means you're not actually buying in something to resell, you're selling your expertise. But let's, for this case, say that we're talking about a shoe shop that actually buys in products and then resells them. So in this case, we'll be talking about sales. Now, the cost of sales is the cost of the shoes that this business pays from a wholesaler. The cost of sales may also be called cost of goods sold. It is a variable cost, and indeed is called a variable cost by some accountants. And your gross profit is a subtraction of the cost of sales from the sales. Pretty standard. And I'll give you an example in a minute of how that actually works. The thing that I want to show in this video is the importance of understanding the gross profit percentage. Now, many profit and loss statements do not show the percentage. In most cases, they show the sales or revenue, the cost of sales, and the gross profit. And then they carry on to the rest of the profit and loss statement that shows all the fixed expenses and so on. You'll also find in a lot of profit and loss statements there are other sections here that I won't go into right at the moment. This is to get an understanding of the basic principles of the profit and loss statement and the importance of the gross profit and gross profit percentage. So let's take, for example, this shoe shop that in the month of May sells $5,000 worth of shoes. Now, in order to get that $5,000 worth of shoes, they paid $3,000 to the wholesaler for those shoes. That means the sales minus the cost of sales is a gross profit of $2,000. Do not confuse the terms gross profit and net profit. Gross profit does not include the costs of all your other expenses, things like advertising, electricity, rent, and all the other associated costs with running a business. This purely is the sales revenue that you've made, less the cost of making those sales, in this case, the price of the shoes that you paid for the wholesaler, and that gives us a $2,000 profit, which is 40%. That means that for every $100 in sales, you now have $40 to pay for all the other expenses. Things like I said, advertising, rent, and so on. So let's say, for example, we decide to have a bit of a promotion and have a discount and to increase our sales. So in this case, this shoe shop now sells $7,000 in this month, but the price of the shoes per pair of shoes has not changed, but we've decided to discount the pricing to actually increase our sales. So now we've made sales of $7,000, but our cost of sales haven't changed per unit basis. So that means we still have a gross profit of $2,000. That means that out of every $100 in sales, we now have $29 to spend on the other fixed costs and to have a net profit at the end of it. So straight away, you can see that just by increasing your sales through lowering your prices or discounting does not necessarily mean to say you're going to make a profit. In fact, there are many instances where it can actually be less. For example, let's talk about a massive promotion where we're going to give away, say, another pair of shoes with every pair that you buy. And so we're going to actually have this huge promotion. And now we actually find that the actual cost of shoes, so we've sold more shoes, but the price hasn't changed. The wholesaler hasn't discounted the price. We've just decided to discount our resale price to make more sales. So we've now got sales of $10,000, which is double that of May, but we've still only made $2,000 in gross profit, which now is a gross profit percentage of $20. Sorry, 20%. So just increasing your sales obviously is not going to necessarily increase your gross profit. In fact, we can go to the other extreme and say that if we had $10,000 in sales and a huge discount, and we didn't get much of a discount from our wholesaler, but we just wanted to increase our sales to make the figures look good, we can actually reduce our gross profit to $1,000, and we've only made a 10% gross profit. So let's say, for example, we now look at a situation where we have increased our sales through better sales techniques, better sales methods, incentives for them, for your customer to buy your shoes, but without discounting and without giving away extra pairs of shoes or whatever to actually reduce our cost of sales. So in this case, we'll say that these shoes actually cost us $10,000. So now we've made $5,000 profit, which is 2.5 times that of May, selling only $5,000, and there's a gross profit of 33%. But again, the point that I want to make here is that that $33 per $100 of sales is going to be used to pay all the other fixed expenses. So if in order to get that higher level of sales, you did a lot of advertising and a lot of promotion, then there's going to be a bigger chunk taken out of this $5,000. So in fact, if we looked at lowering our level of sales because we maintain our price, but a reasonable amount of promotion, improve sales techniques, and also other incentives other than necessarily giving away stuff, we can actually see how we can actually increase our gross profit. So although we've made $4,000 in gross profit, which is $1,000 less than September, our overall percentage is 50%. Again, what I'd like to say there is that this means that you've now got $50 in every $100 to pay for your other expenses. So if in this month of September your sales were your sales were good because of very heavy advertising, increased advertising costs, you could actually end up making a loss in that particular month, even though your sales have gone high. And this is one of the reasons why so many businesses do fail, because they tend to focus on these figures. And don't get me wrong, I absolutely understand that is an important aspect of running the business, is to increase sales, but it has to be taken into account with what's happening down on this line.